Okay, hello everybody, and welcome to Investing with IBD for October 2nd, 2019. I'm your host, Arisha Pierce, and with me today is Jim Roppel, hedge fund manager, longtime IBD customer, and featured in a few investing books. I have one right here, a John Boyk book that I loved, and Jim was heavily featured in this one. So thanks for being here, Jim.
How you doing? Great to be here.
On today's podcast, we will talk about the current markets, the obstacles that investors face, and current stocks. So let's get right into the current market. The market is under pressure. We theoretically could go into a marketing correction today, too, with the way the markets were acting. We have 6 distribution days on the NASDAQ, 5 on the S&P 500. Obviously, a choppy market. Index is below the 50 now. Jim, what are your thoughts on this? Having fun in this market?
It's actually a lot easier now because it's so obvious, and I'm not shocked at all because the true market leaders kind of blew up weeks ago, and I was actually stunned that the indexes could hold within 2, 3, 4% of the highs.
Right.
I knew something had to give. I knew the indexes were going to go down or the stocks had to go back up, but this vacuum had to close.
Yeah.
So I'm not shocked.
Yeah.
And it's easy now.
Exactly. You got to sit and be patient.
It's hard making the decision, are my stocks topping or is this a normal correction? That's when it's really tricky.
Right. That choppy market's always the most dangerous market.
For sure.
So right now, the best thing anyone can do is, let's assume we're almost in a correction, is be patient, stay on the sidelines, let stocks prove themselves, build right-hand side bases, right? I
think stay vigilant, stay attentive, build your watch list, watch the potential new leaders, stay in the game. And this is the best time ever because if we do have a decent correction, it's going to set up really great bases. I actually get excited when the market goes bad and the more it goes bad, the more excited I get because the bigger the bounce and possibly the bigger, more powerful follow-through day you'll get.
That's well said right there. I mean, what I always like to say is we love corrections. We're going to protect ourselves, and there's going to be that great opportunity. Kind of like last year. We remember last year it was terrible, and we finished the year. But then all of a sudden January came around, and we had all these great opportunities to get in all of these cloud stocks that went up on a huge run.
Yeah, again, that December bottom, Christmas Eve.
Yes, the Christmas Eve massacre.
Massive present.
Yes, exactly. So, Jim, let's move on to another topic, and I think this is a great topic. But how you got started. So, why don't you walk us through this? How you got started in stocks, and then how you got into IBD and the whole growth strategy.
My parents were German-Russian immigrants. They came to America. They went to work in Chicago in the Bally pinball machine factory, stamping out decks of pinball machines, and they all got stock options. And so my grandfather watched Bally, and my dad was watching it, and Bally went from they invented Space Invaders, and it went from 18 to 80, and my dad thought he was rich with his 200 shares. And so I started listening to my dad, and then my dad inherited a little bit of money, and he put it in the market and gave me some to learn to trade with. And basically my parents and my grandparents were not wealthy by any stretch, but because of that. And then went to college, the crash of 87 happened, and I was riveted. I literally ran from my dorm to the coin shop to buy silver when the market was imploding.
Wow.
And we would download options on CompuServe for $5 a minute, fixed pricing on options, and shut it off immediately. And I loved the markets back then, but the crash really pushed me over. I graduated in December of 87, got a job as a cold call stock jockey, and lost money for all my customers for from 87 till I found the paper one day at a 7-Eleven, and then I read the book, and I would read the paper religiously, and I would take the top of a paper copier box and put it up like a picture frame and cut all the little charts out and line them in there. And the best stocks would be over and over again, have those mini charts in there.
Yeah.
And I really started to believe it. And I used to drive at midnight to the paper depot a few towns over to get the paper the night before and read it at like midnight, 1 in the morning to get a big jump on it. I mean, I was
So
total.
hold, Jim. You would go at midnight. You go and get the Investors Business Daily newspaper, the daily newspaper back then. And you didn't have the patience to wait till tomorrow. The next morning, you were that eager to just get right there. So you went right to the distribution center.
Yeah,
That's
the paper
amazing.
dudes would hand it to me for free. They thought I was insane. But yeah, I was totally into it. And then it started to work.
Yes.
I mean, the first thing was cutting my losses. Like I did pick up some really good winners, but my losers were so horrific it blew them out. And as soon as I started cutting my losses, the performance immediately changed. I cutting losses and implementing better metrics in the stocks I was selecting. Just it changed everything. Um, it, so I knew it worked.
Yeah, and now mentioned in the book that I have right here, one of your winners, and this might have came a little bit later, is iOmega,
Yeah.
and that was a revolutionary device back then. It completely fit the system, right? It's like you could hold so much more data on those disks. I remember using those way back when, and then it just became they're selling like crazy. You can and it reflected in the huge earnings, huge sales.
And that stock discounted probably 5 years forward worth of earnings in about 9 months. And it was one of the first stocks that I really noticed, my God, it's 200% over the 50-day, which
Wow.
I'd never really seen before. And I didn't have hardly any money back then. And so it just was everything to me. I mean, it was a great stock, a perfect can slim stock, I think.
Yeah, yeah, and it. I think there are a number of really cool lessons, especially looking at the chart, the markups in the book. You had the patience to let it work for you. One of those, and we'll talk about this more in segment two. You know, one of the kind of the flaws for all investors, or one of those obstacles that all investors need to get over, is let those profits run. Everyone's so quick to take the profit, especially me. You know, you just feel that I don't want to lose that. But you had that patience to you knew the story, and you had the patience to really see the story work out in the stock.
That's a massive double-edged sword. I mean, my strongest point is being able to sit, but I don't fall in love with them, but I know for a fact, because I did a study, the average TML, true market leader, runs for about 98.2 weeks. And so I know stocks don't triple in 2 weeks, I know you've got to sit.
Yeah.
But then often I get confused between tops. If it doesn't blow off top, I struggle, you know, because most stocks are going to come down to the 50. They're going to undercut the 50. They'll stay 2, 3, 4% below the 50. After that, it's damaged. But my holding is probably my strongest suit, but it also has hurt me greatly.
Yeah.
I've given back way too much. I mean, I'll just say this really simply. After huge strings of massive success, everyone is prone to doing really dumb things. I mean, I don't care who you are. I'm sure George Soros and Paul Tudor Jones have done really stupid things and hurt themselves. So no matter how much success you have, you can screw it up, even after 30 years of success.
Yeah, yeah. It's that's part of being human, right? It's and the markets might change slightly, the environment, and yeah, everyone's going to go through that. You know, everyone's going to base in their trading lives too. They're going on these good runs, they base, and then you kind of have to work it out, hopefully, to come out of that.
And that's what I'm kind of hoping for right now in a couple of the past cloud leaders, but we can talk about that maybe later.
Yeah, yeah. So let's talk a little bit of the conviction that you developed, because the holding, yeah, it's a strength for you. It can be a weakness, but I think that conviction, you having the ability to really research the company and figure it out, to have that kind of gumption to hold, you know, a little bit more, could help everyone who's listening to this.
If you're purely technical and you don't understand the fundamentals, you're just going to get shaken out when the stock has a bad reaction. And if you understand what their market position percentage ownership is today, what it could be, you can sit through these shakeouts as long as they don't violate, 50 moving averages and things like that. But if you don't understand intimately exactly what's going on with that company, you're going to get shaken out. And that's like the greatest mistake I hate opening up the newspaper on New Year's Day and seeing the list of the best performing stocks for the year and going, I owned 80 or 90% of these, but I only made money on like 3 of them because I got whipped out like a rookie.
Yeah. Yeah.
I mean, getting shaken out, not being able to sit, getting shaken out when a stock pulls down back on lower volume that it was going up on, it's just kind of a normal thing. But if you don't know those fundamentals, you sell, you panic.
Right. Right. What about when all of your stocks come down at the same time as our stocks are, or at least my portfolio? It seems like I have a tendency to pick all those stocks that like to go down 8% all in one day.
Okay, we just kind of had almost a black swan event where we had kind of a bear market in growth.
Yeah.
And money management is absolutely imperative. It's, after cutting losses, it's probably the second most important thing. But if you say, well, on an earnings gap, it can gap down 10, 20%. And if it's 10 or 20% of my account, I can lose 3, 6% of the value of the account. Well, that's not true, because it's probably the best stock in the market you're holding, and it's going to wreck everything else in your account. So you're not just going to go down 3% of equity or 4%. It's going to be way worse. So that's the answer to that for me.
Yeah, yeah, and sometimes you just have to. I mean, that also comes to the conviction, though, too, right? You're cutting from the bottom, or which one is the one that I'm going to ride or die, essentially, with, as long as it doesn't break the 50-day moving average or something. These other ones are kind of good stocks.
It can break the 50-day, but it shouldn't break it by more than, say, 3-4%, and it should be doing better on a Friday close. I look at the 50-day more on a Friday close, and I also look at the 50-day in relation to how close is the 50-day to the recent, like, has the stock been digesting and the 50-day and the stock have converged?
Yeah.
Like, I'm not going to flip out and sell if it breaks below it and they've been diverging together.
Okay, no, that makes a lot of sense. So to recap here, the indices are starting to sell off more. So just make sure you are protecting your principal. Let's take a quick break, but when we return, we'll continue this conversation and get more into some of the obstacles that investors face and that the obstacles that we all have to overcome. Okay, so stay tuned. Whether it's fear, greed, hope, or pride, to become a successful investor, you need to know how to overcome these 4 emotions when your money is on the line. Join us for a free IBD webinar on October 8th, featuring special guests Scott O'Neill and Chris Gessel. They'll show you how to fix bad stock market habits you may not even realize you've adopted. Go to investors.com/webinar to register today. Jim Roppel is our guest on Investing with IBD. Okay, Jim, let's continue this conversation and really get into some of the obstacles that we all face, right, in the markets today, and really face with ourselves. And I'll make this simple. Why is this so hard, right? Why is it so hard to trade, and as an investor or as an active investor?
Well, because it takes almost a superhuman to embody all the characteristics required to be successful. I mean, how about emotional control, not having FOMO and buying extended, not panicking when things go bad and you really shouldn't sell? How about consistency? You've got to consistently implement throughout for years.
Yeah.
You've got to have the greatest discipline to take your losses when you have them. No ego, choke down on 5 losers in a row. Technical patterns, cups and handles, flat bases, they morph. You see a perfect cup and handle, and it then morphs into just a failure. Like to sit through the adversity for years and compound out your money. I mean, I went to a seminar one time Bill gave, and Bill's like, I'm sorry, I meet this guy, and he's like, oh, I'll open an account with you. And I had like 5 small losses in a row. He's like, this system's the worst. Like, he wouldn't sit for 5 small, 5% losers in a row.
Right.
People don't have discipline. I mean, discipline, emotional control, consistency, these aren't normal human, very few people have that. And that's why even the greats make a lot of mistakes. But getting back on your game and staying in, realizing you've gotten off track and bringing yourself back in, it's an emotional battle. I mean, why don't people succeed? I could name 10 characteristics that are all emotional that very few people possess three of.
Right.
You need them all.
Yeah.
And you can do it for years over and over and over again.
Yeah. I mean, if you have 5, 6 losses in a row, it's hard to pick yourself off the floor. Just that emotional toll that you get. You just start that kind of like what I was talking to you before we started this. I feel like, for the last couple of months, I felt like I was snake bitten. Everything I touched wasn't working. But in the end, the market was also, telling me something there too, to slow down, go smaller. But that takes years to try to learn and listen to the market.
I mean, anybody in the world who has MarketSmith or Wanda can screen for these key variables that we all know are necessary. Anybody can do that. But what separates winners from losers is consistently implementing the method with emotional control, discipline. That's the hard part. How do you react when 4 of your 5 stocks go down 6% in a day? On volume, how's the volume in relation to history? I mean, that's the kind of thing that only experience over long periods, can help you through. It's not a shock why people don't make money in the stock market.
It's true, especially the way you say it. I know it goes against human nature.
Totally. I mean, how about being selective, like not having FOMO? This, like you see, like, fishing lures, they have those spinning things that are all silver and attract you.
Yeah.
If you're watching the market every day and you're watching everything bounce up and down, you're prone to just buy it.
Yes.
Because it's moving out of a okay base, and maybe there's a bunch of variables that aren't quite there, but it's moving, so you jump on it. You're wasting your time. Being selective is critical. Like, imagine you could only make 1 trade a month. Would you make the trade you're getting involved in right now? I mean, the more I trade, the more I lose. When I got started, I traded just radically over traded. I used margin too much, and now I literally will go sometimes a month without putting an order in.
Wow.
In a perfect world, I would be 100% in cash at a bear market bottom, and in the first 3 days after a follow-through day, I'd go 130% long. I'd sit all the way until the market blow off tops, 9 months later, and I'd get 100% out. I'd make no trades in between.
Yeah.
But to do that is perfection, and that's not reality. And I also, I'm way off topic.
No. Please go. Keep going.
Okay. I used to go for just massive monster home runs all the time. And now when things get really extended, I'm starting to learn to trim and hedge. When things get grossly extended beyond the 50-day, more than historically they have been. And it's a very hard process. And oh God, I did the biggest bogey in the world when NVIDIA gapped out of its very first base at like 18 or 30.
Uh-huh.
Well, I ran a screen, a volume percentage screen, and in the middle of the day, I see it. It's running wild. Volume's like 300% over. And I just went and bought a couple 100,000. I bought a lot of it.
Yeah.
And my assistant, Eve, calls me. She's like, hey, goofball, they report earnings tonight, right? I had no clue. And I'm like, well, I'm just going to risk it. The volume's too great, and it explodes out. I added, I think, a couple days later. And what did I do? I had no idea I had the biggest winner in the world. But because the earnings estimates weren't huge, as analysts at the time only thought earnings were going to be up like 1%. I trimmed off a third of the stock up 20%.
Yeah.
The stock went to Mars.
You're right.
And before every earnings report, I trim off a little more. And I took a stock that should have been a career stock. And because I'd had a rough stretch and I started to implement trimming when things get extended, I made great. It was a wonderful trade. But it could have been a career trade.
Yeah.
So I kind of started to implement my new method right into one of the best stocks I'd ever tangled up into.
Yeah. Well, now, so it seems like with NVIDIA back in 2016, you found it first on the volume screen. You bought you bought the shares. The earnings you survived earnings. Now, at that point, are you just going through and saying, okay, why are these guys getting tons of volume? Because I remember seeing it at that point too. It took me a little while to wrap my head around that. Hey, they're no longer a gaming chip. Their chip is being placed in machine learning, self-driving cars, artificial intelligence, everything, all the major growth areas.
Yeah, I mean, the one thing was there was a stock 20 plus years ago called 4 Systems, and I'm going to overstate the case, but analysts were estimating that the following year they were going to earn like 50 cents. Well, they ended up earning 250. Earnings beat is imperative in almost every true market leader. So NVIDIA, I'm looking at, I'm like, what are the analysts missing here? The stock is charging ahead. Institutions are gang tackling this thing. And the analysts are so far behind the curve, they had, when it first broke out, they only had estimates like even the following year and like up 1% the year after that. They were completely behind the curve.
Yeah. Isn't that the case, though, usually? The analysts are, for some of these great growth stocks, they're going to be behind the curve, and then the upgrades and stuff come a little bit later and all that kind of thing. They're trying to always catch up to the story, it seems.
Yeah, I mean, that's why stocks rise. You have new information. You have an earnings surprise is integral to almost every monster stock because the new earnings come out, beat and raise, then the stock rises to accommodate that new information. And you need to get a real crushing win. You need 5 earnings beats in a row, and you're gonna have a career stock.
Yeah.
But the problem is
getting through those.
Well, how about you get a stock that just is absolutely beautiful, and you go, this is it. This is my news. This is my Cisco. And you think it's going to have 5 earnings beats in a row, and you treat it like that, and it has 2, and then it blows up.
Yes.
You think it's going to have 5.
Right, exactly.
You know, I've done that before.
Yeah. Well, I mean, going back to that, the fact that you're trimming before earnings or taking some off, I mean, I can't really fault you for that, especially with the way the earnings gaps are these days, where they massively gap up or massively gap down, kind of like Xilinx. You know, Xilinx started off kind of that picture perfect breakout out of their earnings report, runs up 40%. And I had that, and then I was like, you know what? I sold some, but let me hold some in the earnings, and it gaps down 20+% afterwards. It's a coin flip a lot of times, it seems like these days.
It is. It can be a minefield, but I think you have to have a feeling for how the most recent report's been received by the market.
Okay. Because
even a great report like Team is going to report in pretty soon, and I'm very fearful that even if they have a great report, they're going to smash the stock.
Yeah.
You have to know the environment you're in, and the government regulators really screwed the investing public by not letting information seep into the market over time as to it's all or nothing.
Right.
The CEO can't talk to an analyst now interim and disclose material information. It's got to be broadcast to everybody. So it's created a minefield. Stocks don't trend beautifully like they used to. It's kind of like I read a study, and I think it said, if you weren't in Amazon for all the earnings reports, you missed 80% of all the move. I mean, stocks move most of their moves on earnings.
Yeah.
You've got a risk.
Yeah, no, I mean that's a good point. Now, speaking of risk, you know, one obstacle that investors face a lot of them, especially when they are newer to this, is having the confidence to buy on a falter day. And a falter day is that signal that we look for in the market that the market has a potential chance now to go from a downtrend to an uptrend. Any advice for those out there who are struggling with this?
You have to force yourself, and I forced myself to buy 4 stocks within a day or two of the follow-through day because I went on vacation once. I was all in cash. We had tiny little kids, and my wife's like, "Oh, thank God, he's finally out of the market." And boom, second day on vacation, we have a follow-through day. I buy 3 stocks.
Yeah.
All 3 were not leaders. They all failed, and the market went on to be a monster. And I said, well, I guess it's possible for you to make 3 bogeys in a row, but it's not 4. So now I try to buy 4.
That's interesting.
But what I would say is just force yourself in. Buy whatever. Often I don't know the fundamentals intimately, but I see the price and volume raging. Even sometimes after a really bad bear market, like there was a couple that broke out in 03 before the follow-through day, and they were just so obvious. And ERES might have been, I can't remember the name of it, but buy a stock making new high on great volume if it has all the metrics, even though you don't know the fundamentals, and risk, and then study the heck out of it and try to understand what you have, because you might have a piece of a stock that's going to change your life. If I said most stocks have monster runs for about 98 weeks ish. That's from the beginning of a new bull market.
Right.
If you have a bear market and you get into a stock making an all-time new high as the market's making a low or following through, you probably have gold. It's a very good chance.
Yeah. Yeah.
So force yourself in. That's the biggest opportunity. But you're going to be like, the Fed is tightening and Russia's going to attack Croatia or whatever. I mean, there's going to be a million issues. You're not going to want to do it, but you have to.
No, that's true. That relative strength, and this is why we all love corrections around here, is because it gives you an opportunity to see the relative strength of stocks and which ones are dramatically outperforming the market and starting to hit new highs. And they're not necessarily obvious to everyone just yet. But the market's saying these are the ones that the funds don't want to sell. They're in fact buying a little bit more of those when the opportunity is there.
If you're listening, the market will tell you. I mean, if you got into, I was so fortunate. I got into AYX and Roku just in this last cycle.
Yeah.
And the stocks just spoke to me. They never, ever gave me a moment's worry. It was easy to make those my biggest positions because they just acted great. And the other things, I had some other things that worked a little bit or didn't work at all. I just got rid of them. If you're listening to the market, it's going to tell you. Listening to the TV or other experts is probably going to be really detrimental to doing the right thing. But if you listen to the price, it's hard. Listen, the greatest buy list in the whole wide world is the new high list. If a stock's going to go from 50 to 300, it's got to make a new high all the way up, and it's going to be in the paper every day.
Yeah.
If you only had one list, I would just go with the new high list. It's worth this. God, how could you not subscribe to the paper to get that new high?
That's perfect. Well said. So understanding all of the obstacles that an investor must face is essential to overcoming and growing as an investor. Coming up next, Jim and I will discuss 3 stocks that are hanging around in the market today and ones to keep an eye on once this market turns around. Stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We are back with Jim Roppel. So, Jim, let's get into current stocks. But before we do that, let's talk a little bit about IPOs.
Okay. My assistant, my friend Eve, who runs my small fund for me, just wrote a book. And it's a phenomenal book. And I learned that I hate IPOs. I like seasoned IPOs. Eve uncovered a statistic that I'm going to paraphrase, but something like 95% of all stocks will undercut their initial day open within 1 or 2 years. So I hate those odds.
Yeah.
And she also uncovered something called the institutional due diligence phase, which I understood subliminally, but I never had it brought to light. She explained that it takes a year or 2 for institutions to do their research and then support the stock. I just think the odds are so negative with IPOs. They're illiquid. As soon as you get a monster on hand, like I just had Pinduo, PDD, and they announced a secondary, and I got slammed on the thing. It looked great. I just find it to be way better to get in there 2 years after they come out and just avoid all of the pain and all of the mental beating up and getting stopped out of these lower volume, less liquid names. And here's another thing. I was in a lot of the great IPOs just because they fit the CanSlim template perfectly. Google, that company began with an A year or 2 ago. The point is, if you're looking for the key variables, you're going to get them whether they're an IPO or not. But just looking for an IPO, I think, is counterproductive. And the other thing is, I think liquidity mixed with extremely high earnings growth is like the magic elixir.
Interesting.
Extremely high liquidity is key to almost all of the true market leaders, and most IPOs just don't possess it. So that's seasoned IPOs could be gold,
yeah,
but new IPOs mostly losers for me.
Yeah, no, that makes a lot of sense. And now let's get into some of the current stocks. And some of these went through, kind of fit that characteristic, those seasoned IPOs. Now, the first stock that we're going to talk about is Okta. And this was a security stock. These guys have done quite well. But like a lot of the other cloud stocks, they've gotten hit recently. What are you seeing here?
Well, the one thing I want to point out is on Okta, on the day of 3/8/19, it had one of the most unique days where it gapped down. See, at 70.44, it gaps down. Yes. That was on earnings.
Yes.
And it closed above the 50. It almost closed up in volume 9.5 million shares, which was one of the heaviest days it's ever had.
Yep.
To me, when I saw that, it looked identical to the greatest stock I kind of have ever seen in my career, which was Ascend Communications. On 10/5/1994, I owned Ascend, and I had probably like 200 shares or a very small position. It gaps down. I'm like, oh, it broke the 50. This is a disaster. I puke it up.
Yeah.
And Ascend went on to go up 3,936% in 98 weeks.
Oh, my God. I remember that chart. That's one of the most epic charts out there that you can look at. And
look at the date of 10/5/94. It was a just crazy shakeout. I created a rule. If I get shaken out of a stock and it closes above the 50-day, I have got to get back in. So now I'm out of – well, that's a little bit of a misnomer. I have a tiny little position in Okta now. Maybe like 8% of my account is in it. It possibly could be cupping. It's probably really damaged goods. I overstayed my welcome.
Yeah.
I have a rule. I call the 50-day moving average the guardrail. And I violated my own rule. I puked out some, but I believed in it too much, and I held it through the 50. And I've had a significant drawdown. I've turned a year that was a triple into a base hit, but I was going for the grand slam.
Okay.
So I would look at Okta and maybe see if this is going to round out, which I really think ServiceNow has a much better chance of, because as the market's been making a lower low, ServiceNow really hasn't. It made a very marginally lower low. And it seems to be much further into a basing process.
Yeah, so let's go over to that. Let's switch over to ServiceNow. Then the ticker symbol for that is NOW, and you're right. I just pulled up the chart for ServiceNow, and it looks a lot more constructive than the Okta chart.
Well, it's only 18% off the high.
Yep.
It is trying to hold the 200-day. As to where a lot of real leaders are down 35%, and even some cases like Roku, like 40+%. I am trying to elongate my time horizons with stocks and trying to hold them for really big moves. Like I said, if a stock's average monster run is 98 weeks, you've got to be willing to sit through real pullbacks, new base building. I'm not a base hitter. Day trading is just insane to me. I'm terrible at it. But I want to hold, and so I'm trying to see. I have about an 8% position in ServiceNow, and I'm going to see if it bases. And if it undercuts the recent lows, I'll just get out of everything. And maybe we're going to if that happens, maybe this market's going to get a lot rougher.
Right.
But I think it's still earlier in a secular bull market.
Okay. And now we're talking about position sizes. What's your typical position size? Around 20%, 30%?
When I got started a long time ago, sometimes it would be 40% of the account, and I'd put it on margin. But now I think I don't want to – I run partner money, so I can't take crazy risks. I think I would never take a position less than 10%. How often do you get a 100% winner? Well, if you have a 10% position, it's a 100% winner, you only made 10% of equity.
Right.
You need minimum 10%, but when you get over 18% and you get into earnings and minefields, it can be too detrimental. But 18% on a 100% winner is meaningful. If you get 300% winners at 18%, now you're having a very good year. Subtract out your losers. This is so important. I can't. After cutting your losses, money management is even more important than selection criteria.
Yeah. Yeah.
So.
Yeah, and I've said that a number of times. Sometimes it doesn't matter the strategy. You have to find a strategy that works for you, but every strategy needs some kind of money management to let you know when you're wrong and free up some of that capital.
and not to take excessive risk. I've seen hedge funds in beautiful stocks almost get wiped out. It's not worth the risk. You want to stay. I've been doing this for 30 years, primarily because I always cut my losses. I'm not a disciplined person, maybe so much in my personal life, but in this life,
Yeah.
it's kept me in the game. It's the golden. If you want to stay in this game for the long time, you want to not just get rich, but stay rich. Loss cutting, money management. You could throw darts at a paper, you paste it up on the wall, and cut all your losses at 3-4%, and take all your gains at 20, and you're going to make money with no selection criteria. You employ good selection criteria on top of that, which all the variables are in the paper most days.
Yeah.
You're going to make money over time. But who has the discipline to stay with it for 20 years?
Exactly. It's so true. It's always there. Yeah. I mean that's those obstacles again. Let's go to another stock. This is Docusign, ticker symbol DOCU, and obviously these guys have a great story going, and just makes it so much easier to sign contracts. And most people who've bought a house in the last 5-6 years, they've probably used a Docusign or something like it. What are you seeing here?
Well, you had this volume up, earnings volume gap explosion.
Yep.
And I just think I would say almost a third of the stocks I've had that I've made a lot of money on, I didn't really even know them that much before that earnings volume exploded up. And this one fits it perfectly, and it's even withstanding the down trend in the general market and more in growth stocks. So it's really, really showing exceptional strength. It's talking to you. The market's talking to you. But I am not getting involved with it because I'm so general market makes the odds negative for me. So I'm watching it. If we had a follow-through day, this would be the first stock. I would go right here, immediately right to this stock. I think it's got a chance to, if we don't have a bear market, which I'm not predicting, but if we have a bull trend emerges, this is likely to be very good chance it could be the leader.
Yeah, it's right near new highs, and it also is fitting the IPO concept that you were speaking about earlier, where it's been basing essentially for a year and a half or so, and now this given enough time for the funds to do their research, and now if you get into a new bull market, this could be one of those ones that they go to first.
The institutional due diligence phase is over or near over, and it had a blowout earnings report. And again, there's the beat and raise quarter. It has a great fundamental story. This could be a monster. So I'm watching it, and I'll be watching it from China in 2 weeks. Hopefully, move without me.
And if to take a look at Docusign, they have triple-digit earnings. Every quarter besides its most recent report was triple-digit earnings, huge sales. And there was something you learned from Bill O'Neill a while back about triple-digit earnings, right?
Well, I had a little snag in my trading, and I sent him some charts, and he goes, anytime you have a stock with triple-digit sales and earnings, you cannot sell it until it breaks the 50-day. And he wrote, in handwritten to me, he wrote, triple-digit sales and earnings stocks can go way farther than anyone thinks. So I have screens that exclusively screen for all variables better than 20%, 40%, and then triple-digit sales and earnings. And those are like gold. There's only 5,500 public companies. Right. I'm really only interested in like 10 of them. They meet those metrics, and DocuSign's one of them.
Yeah, that's really, really cool. Let's go to one more stock here. This is Atlassian, ticker symbol TEAM. This is one of those first stocks that emerged out of the bear market from last year, and like a lot of these other cloud stocks, they're basing right now. Hopefully they're basing. Hopefully it's not much worse. But what are you seeing here?
Again, it reminds me of ServiceNow. I don't like the light volume rally off the 120, but It is only 18% off the high. You're going to have some bad volume characteristics on the left-hand side of a cup.
Yeah.
And I'm pretty bullish on this. If we were in an uptrend, this is probably, if it would start to work up the right side of a cup, I would have to be, I am in, again, about 8% of this thing. But all three of those stocks I'm holding from way back. I mean, I'm up like 50% on all of them.
Yeah.
So I have like remnant positions. And I think it could end up being I don't think the build out in cloud is anywhere near over. I think we're in like the third inning. Like this is going to go on for a long, long time. And these guys are a leader in this space. Their earnings are great. They have a little institutional sponsorship. And but if it undercuts the recent lows, I will get out of everything. If these three stocks undercut the recent lows, I would think there's a good chance the market is way worse than we think.
Yep.
I mean, who knows?
It was kind of like last year too, where it was hanging around a little while during September and October, but then those lows were undercut, and then it just got worse and worse and worse.
I mean, think about the weed stocks, like Canopy Growth.
Right.
Everybody's like, these are the greatest stocks ever. Humans are going to default to the lowest common denominator. Everyone's going to smoke weed.
Yeah.
These things go to Mars.
Yeah.
And they've been the biggest disappointment. If you had normal cell rules, there's no way you're in any of that stuff.
Right.
But the hype was so enormous. If you undercut the lows, it could get way worse than you think. Just take a look at Canopy.
Yeah. I think that's a great example to end on, because that was on my watch list for a while this year, but it just never set up, and it just kept getting worse and worse, and that's the magic of charts. So there are a number of stocks there that have gotten hit in this market, but you want to keep them on your radar because they do have great fundamental stories, and they could eventually form bases. But in the end, as Jim has mentioned a number of times here, if they start to undercut the lows of their most recent lows, they could be in a little bit more trouble, and this whole market could be in a lot more trouble. So thanks, Jim, for joining us today.
Great to be here. You know what you said? Let's end. And we ended on a negative stock. Let's end on a super upbeat, optimistic conclusion. It's just another at-bat. And I'm 54. I think I lived to 95. I'm going to have 2 or 3 at-bats every year for the balance of my life. I'm probably going to see 250 real true market leaders. And anybody can do this and start with a really small amount of money and make life-changing money. So let's finish on that.
I like that a lot. You're great inspiration, and so thanks so much for joining us.
Thanks, dude. Have a great day.
That's it for this week on Investing with IBD. Next week, we will have David Keller, Chief Market Strategist at StockCharts.com, President of Sierra Alpha Research, and it was pretty cool, but he also used to lead the technical analyst group at Fidelity. So that's it. I'm Arusha Pierce, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.